Warren Buffett's net worth is $130 billion. He's arguably the greatest investor who ever lived. But here's the part that nobody talks about. 128.7 billion of that came after his 65th birthday. Let me say that again. 99% of his wealth was earned after most people retire. Warren Buffett's skill is investing, but his secret is time. This is chapter 4 of The Psychology of Money, Confounding Compounding. Compounding is the most powerful force in all of finance. Einstein may or may not have called it the eighth wonder of the world, but it doesn't matter who said it. What matters is that almost nobody truly understands it. And the reason is simple. Compounding is counterintuitive. Our brains think in straight lines. If I earn 10% this year, I'll earn 10% next year. So in 10 years, I'll have doubled my money, right? Wrong. Because compounding doesn't work in straight lines. It works in curves. And the curve starts slow, painfully slow, and then it explodes. The counterintuitive nature of compounding is responsible for the majority of disappointing trades, bad strategies, and failed financial plans. Because people don't design their strategies around compounding. They design around short-term returns. They want to double their money in 1 year. They want 50% returns. They want to find the next multi-bagger stock. And in chasing these big, flashy returns, they miss the quiet, boring, unstoppable power of compounding over decades. Good investing isn't about earning the highest returns. It's about earning pretty good returns for the longest period of time. This is the most important financial advice you'll ever hear. Let's look at our first story, the Warren Buffett story. Let's go deeper into the Warren Buffett story because the numbers are genuinely mind-blowing. Warren Buffett bought his first stock at age 11. By 30, he was worth $1 million. By 50, after nearly 4 decades of investing $250 million. Impressive, but not headline-making. Then compounding took over. By 88, he was worth $84 billion. By 94, $130 billion. Consider the math. In his first 40 years of investing from age 11 to 50, he accumulated $250 million. In the next 44 years, he added $129.75 billion more. Over 99% of his wealth came after his 50th birthday, the vast majority in the final third of his life. And here's the key question Morgan asks. Is Warren Buffett the best investor because he gets the highest returns? No. His average annual return is about 22%. That's incredible, but there have been investors with higher annual returns. Take an example of Jim Simons. Jim Simons of Renaissance Technologies averaged 66% returns per year. That's 3 times Buffett's rate. So why is Jim Simons worth around $31 billion while Buffett is worth $130 billion? Because Buffett has been investing for over 80 years. Simons didn't start serious investing until he was 50. Buffett's secret isn't just returns. It's returns multiplied by time. That's compounding. Morgan gives another beautiful example in this chapter that I want to share because it shows how compounding works in nature, not just finance. Scientists spent a long time trying to figure out what caused the ice ages. They looked for some catastrophic event, a massive volcanic eruption, an asteroid impact, something dramatic. But the answer turned out to be incredibly subtle. It started with a slight tilt in Earth's orbit. So slight that summers became just a tiny bit cooler, not cold, just a fraction cooler, cool enough that a thin layer of winter snow didn't fully melt by summer. Next winter, more snow fell on top of the leftover snow, and that bigger layer reflected more sunlight, which made things even cooler, which meant even more snow survived the next summer, which reflected even more sunlight. Year after year, decade after decade, century after century, that tiny change compounded over thousands of years, created massive ice sheets that covered entire continents. That's compounding. It doesn't need a dramatic start, it needs a consistent start and an absurd amount of time. Now let me show you how this plays out in the real world right now and why most people still get it wrong. Let's look at our second story, the NVIDIA story. Let's talk about NVIDIA. If you've been anywhere near the financial world in the last 3 years, you've heard this name. In 2024 and 2025, NVIDIA became one of the most valuable companies on Earth, worth over $3 trillion, all thanks to the AI boom. And suddenly, everyone was talking about how they should have bought NVIDIA stock. But here's what most people don't know. If you had invested just $10,000 in NVIDIA stock in 2005, 20 years ago, and simply held it, done nothing, just let it sit there, that $10,000 would be worth over $30 million today. $30 million from 10,000. That's not a typo. That's compounding. But here's the part nobody wants to talk about. Holding NVIDIA for 20 years was not a smooth ride. Between 2005 and 2025, NVIDIA's stock dropped by 80% or more twice. Once during the 2008 financial crisis, and again in 2022 when the crypto market collapsed and gaming demand crashed. Imagine you bought in 2005. By 2008, your $10,000 is now worth $2,000. 80% of your money gone. What would you do? Be honest. Most people would sell. Most people did sell. They locked in their losses and moved on. And the people who held through 2008, they had to do it again in 2022. Another massive drop, another wave of panic, another moment where every instinct screams sell. The people who held through both crashes, who did absolutely nothing, are the ones sitting on $30 million today. That's the price of compounding. It's not free. You pay for it with patience, with fear, with sitting still when every headline tells you to panic. Most people aren't willing to pay that price, and that's why most people miss the rewards. And now look at what's happening. After NVIDIA exploded in 2024, millions of new investors rushed in. They saw the returns and thought, I want that. But they're buying at the top, expecting the 3 times return in next 6 months. They don't want to wait 20 years. They want compounding without the time. And that's not how it works. Morgan explains exactly why we struggle with this. And it comes down to how our brains are wired. Humans think linearly. If I tell you, a lily pad doubles in size every day, and it takes 48 days to cover an entire lake, on what day does it cover half the lake? Most people say day 24. Halfway there, right? The answer is day 47. One day before it covers the whole lake. It spends 47 days covering the first half and just 1 day covering the second half. That's how compounding works, and that's why our brains can intuit it. This is why people quit their SIPs after 3 years. They invested consistently, and their returns look ordinary, underwhelming even. They think, this compounding thing is overrated. Let me try trading instead. But they quit right at the part of the curve where it's still flat. They never get to the steep part, the part where the real magic happens. And it's heartbreaking because the steep part was coming. They just couldn't see it. I'll tell you what this chapter changed for me. It killed my obsession with finding the best investment. I used to spend hours researching which stock would give me the highest return this quarter, which mutual fund had the best one-year performance, which crypto coin was about to moon. And after reading this chapter, I realized I was playing the wrong game entirely. The game isn't about finding the highest return. The game is about finding a good return that you can stick with for decades. Because a 15% return that you hold for 30 years will absolutely crush a 50% return that you panic sell after 2 years. It's not even close. The math is overwhelming. So now, my entire financial strategy is boring. And I mean that as a compliment. SIPs and index funds. Month after month, year after year. I don't check my portfolio every day. I don't react to market crashes. I just let time do its thing. And honestly, it's the most peaceful financial decision I've ever made. There are 3 takeaways from this chapter. First, start now. Not tomorrow, not next month, not when you get your next raise. Now. Compounding's greatest input is time. And every day you delay is a day of compounding you'll never get back. Even if it's a small amount, 500, 1,000, just start. The amount matters less than the start date. Second, don't interrupt compounding. This is the hardest part. Every time you panic sell during a crash, every time you withdraw your investments for an impulse purchase, every time you switch strategies because someone on YouTube told you about a better option, you reset the compounding clock. The single most important thing you can do as an investor is not interfere. Third, redefine what good investing means. Good investing is not about big wins. It's about consistency over time. It's not glamorous. It won't make exciting dinner conversation. but it will quietly, relentlessly build you more wealth than any hot tip ever could. That's Chapter 4, Confounding Compounding. The chapter that proves the most powerful force in finance isn't intelligence, or timing, or insider knowledge. It's patience. In the next video, we tackle Chapter 5, Getting Wealthy versus Staying Wealthy. And this one is fascinating because it reveals why making money and keeping money require completely opposite skills. The mindset that makes you rich can be the same mindset that makes you broke. Hit like if this opened your eyes. Subscribe if you're following this series. We're just getting started. And tell me in the comments, when did you start investing? And what do you wish you had done differently? See you in the next one.